VIP John AG here. Banks just accumulated over 10 million ounces of silver, while retail investors were panic selling at the bottom. Let me say that again. 10 million ounces. That is not a typo. That is not speculation. That is documented COMEX data showing commercial traders, the big banks, the bullion dealers, the entities with the deepest pockets and the best information, loaded up on physical silver during the exact same week retail was getting flushed out. The crash you just witnessed was not an accident. It was not random volatility. It was not the market finding fair value. It was a coordinated shakeout designed to transfer metal from weak hands to strong hands. And if you understand what just happened, you will never look at these price drops the same way again. Silver got hammered to roughly 29.50 on COMEX. Gold pulled back to approximately 3,180 after trading above 3,300 just days earlier. Mainstream financial media called it a correction. They said tariff de-escalation reduced safe haven demand. They pointed to a slightly stronger dollar. They did everything except tell you the truth. And the truth is that the Commitment of Traders report tells a completely different story than the one CNBC is selling. Commercial traders, the category that includes the major banks, reduced their net short position by the equivalent of over 10 million ounces in a single reporting week. That means they were buying while you were watching red candles and questioning everything. Now here is where it gets interesting. This pattern has repeated so many times that calling it coincidence requires willful ignorance. Every major bottom in silver over the past 5 years has been preceded by commercial accumulation during retail capitulation. Every single one. In December 2023, when silver touched $22, commercials were net buyers at the bottom. In September 2022, when silver hit 17.40, same pattern. The banks buy when fear peaks. They sell when euphoria peaks. And the retail crowd does the exact opposite every single time. The COMEX registered inventory currently sits at approximately 32 million ounces. That number sounds large until you realize global industrial demand for silver now exceeds 700 million ounces annually and is growing. Solar panel production alone consumed over 200 million ounces last year, and 2024 projections are even higher. We have approximately 2 weeks of industrial demand sitting in registered inventory. 2 weeks. And during this so-called crash, did inventory increase? Number deliveries continued. Physical demand did not pause because paper prices dropped. The disconnect between paper and physical is not narrowing. It is widening. Let me give you the Shanghai context because this is critical. The Shanghai Futures Exchange silver price maintained a premium to COMEX throughout this entire sell-off. We saw premiums ranging from 3 to 8%, depending on the day. In a truly free market with balanced supply and demand, arbitrage would eliminate that premium within hours. Traders would short Shanghai, buy COMEX, and deliver metal until prices equalized. That is not happening. Why? Because the metal is not flowing. China is keeping what it has. Russia is keeping what it has. And Western vaults are slowly draining while paper traders pretend supply is infinite. The gold picture tells the same story. Gold pulled back from above 3,300 to around 3,180, roughly a 4% correction after one of the strongest runs in years. Central banks bought over 1,100 tons of gold in 2023 and are on pace to match or exceed that in 2024. China officially added to reserves again last month after a brief pause. Poland, India, Turkey, all still buying. The People's Bank of China reportedly added another 60,000 ounces to reserves in April according to official data, though analysts suspect unofficial purchases are multiples higher. These entities are not buying because gold looks good on a chart. They are buying because they understand what is coming. Here is the macro backdrop that makes this setup even more compelling. The Federal Reserve is trapped. Inflation remains sticky above target. Core PCE is still running around 2.8%. The Fed wants to cut rates because the banking system is fragile, because commercial real estate is imploding, because regional banks are sitting on unrealized losses that would be catastrophic if marked to market. But they cannot cut aggressively without reigniting inflation. and they cannot hold rates high without breaking something else. This is the impossible position I have been describing on this channel for over a year. The Fed will eventually be forced to choose between a banking crisis and currency debasement. History tells us they always choose debasement. Looking at the numbers, about 75% of you watching are not subscribed. If this unfiltered analysis is cutting through the noise and giving you clarity, hit subscribe. That is how we grow a community built on truth, not hype. Drop VIP John AG in the comments so I know you made it this far. If it is not for you, no hard feelings. I do not chase empty metrics. I do not sell signals. I do not sell mentorships. I do not sell courses. I just analyze data and share it with anyone willing to listen. Now here is what makes this truly insane. Let me show you the smoking gun that mainstream media will never discuss. The margin hikes on COMEX silver happened at the exact moment banks needed to shake out leveraged long positions. This is not conspiracy theory. This is documented history that repeats reliably. In the week before silver dropped below $30, CME Group raised margin requirements. What does that mean in practice? It means every trader holding long positions suddenly needed more cash in their account to maintain those positions. If they could not post additional margin, their positions were liquidated, forced selling, not because they wanted to sell, not because their thesis changed, because the rules changed at the exact wrong moment. And who benefits from forced liquidation? The entities with unlimited liquidity, the banks with direct access to Fed facilities, the commercial traders who can absorb selling pressure and accumulate at artificially depressed prices. This is not about market efficiency. This is about wealth transfer, from retail to institutions, from weak hands to strong hands, from people who trade on hope to entities who trade on information asymmetry. Let me be crystal clear about what the data shows. The Bank Participation Report released monthly by the CFTC shows exactly what banks are doing in futures markets. The most recent data showed U.S. banks holding a net short position of approximately 25,000 contracts, down significantly from previous months. That reduction in short positions means banks were buying to cover. They were accumulating. They were going less short, which is the same as going more long in a leveraged derivatives market. And they did this while silver dropped 15% from its April highs. They bought the dip, the same dip that retail was panic selling. Here is the connection nobody is making. Tariff negotiations between the US and China grabbed headlines this week. Mainstream media claimed that de-escalation reduced demand for safe haven assets like gold and silver. But look at what actually happened. China did not suddenly start trusting the dollar again. China did not reverse its de-dollarization strategy. China is still accumulating gold at record pace. China is still building alternative payment systems with BRICS partners. The tariff headline was noise designed to give cover for a paper market smash. The real story is that nothing has changed in the fundamental case for precious metals. Nothing. But here is the thing about the physical market that paper traders do not understand. When you sell a futures contract, you are not selling metal. You are selling a promise, and there is no limit to how many promises can be created. COMEX open interest in silver regularly exceeds the total registered inventory by 10 to 20 times. That means if even a fraction of contract holders demanded delivery, the system would fail. This is not hypothetical. This is math. And every time we get a sell-off like this one, more physical metal flows out of COMEX vaults and into private hands where it cannot be lent, hypothecated, or leveraged. The contrast between paper and physical has never been starker. I spoke with a major dealer this week who confirmed that Silver Eagles are trading at premiums of $6 to $8 above spot. That means when spot silver was $29.50, you were paying $36 to $38 for a 1-ounce Silver Eagle. If physical supply were abundant, those premiums would collapse. Dealers would compete on price. Inventory would stack up. That is not happening. Premiums remain elevated because physical supply is tight. Period. On the Shanghai side, remember that the premium represents real demand. Chinese buyers are paying more for the same metal because they need it. Whether for industrial consumption or investment, the demand is real, and it is not satisfied by COMEX paper prices. When Shanghai trades at a premium and maintains that premium through a Western paper sell-off, it tells you everything about where real value exists. Let me address the bearish case head-on because balance matters. If you are bullish on silver and gold, you need to understand the risks. The short-term risks are real, and they are significant. First, margin hikes can continue. CME Group has no limit on how high they can raise requirements. If they wanted to, they could raise margins to the point where only the largest institutions could participate. This would trigger cascading liquidations and could push silver significantly lower in the short term. Second, dollar strength remains a headwind. The DXY index is hovering around 100, down from recent highs but still elevated by historical standards. If the dollar rallies again on risk-off sentiment or higher for longer rate expectations, precious metals face pressure. This is not a permanent condition, but it can cause significant pain in the near term. Third, recession risk is real. If the economy tips into genuine recession, industrial demand for silver drops, solar installations slow, EV production falls, electronics demand weakens. Silver is an industrial metal first, and recession hits industrial metals hard initially. Yes, monetary response to recession is ultimately bullish for metals, but the path through recession can be ugly. Fourth, we could see additional bank interventions. The short-selling capacity of major banks is essentially unlimited because they operate with implicit government backing. They can suppress prices for longer than most retail investors can stay solvent. I am not saying they will. I am saying they can. And you need to be positioned to survive that scenario. Fifth, sentiment can shift quickly. Right now, precious metals have significant retail interest. But if prices stay flat or decline for an extended period, that interest fades. People move on to the next shiny object. Lower interest means lower buying pressure, means lower prices in a self-reinforcing cycle. Now let me give you the bullish case because despite everything I just said, the fundamentals have not changed. JP Morgan holds an estimated 600 million ounces of physical silver. Let me say that again. 600 million ounces. The same bank that has paid billions in fines for manipulating precious metals, Markets has accumulated more physical silver than any entity in history. When you understand that their traders were convicted of spoofing, of placing fake orders to move prices, and that banks still accumulated historic amounts of physical metal, you understand that they know something. They are not stacking silver because they think prices will fall. Mining supply is in structural deficit. The Silver Institute projects another deficit year in 2024, marking the fourth consecutive annual deficit. Primary silver mines are not being developed because low prices over the past decade made projects uneconomic. The average all-in sustaining cost for silver production is around $20 to $22 per ounce. At $30 silver, there is margin. But there is not enough margin to incentivize major new development. Supply cannot respond quickly to demand increases. Industrial demand is exploding. Solar photovoltaic installations are growing 20 to 30% annually in major markets. Each gigawatt of solar capacity requires approximately 2.8 million ounces of silver. The Inflation Reduction Act in the U.S. and similar policies globally are subsidizing massive build-outs of solar capacity. Electric vehicle production uses silver in every control module, every motor, every battery management system. AI infrastructure requires silver in servers, in connectors, in thermal management. Defense applications are growing as geopolitical tensions increase. The world needs more silver, not less. Central bank buying of gold is accelerating, not slowing. When central banks buy gold, they are signaling loss of confidence in paper currencies. They are preparing for a world where the dollar is not the singular reserve currency. When Poland, Turkey, India, China, and Russia are all buying gold simultaneously, that is not coincidence. That is coordination. That is preparation. The monetary backdrop is the most bullish in 50 years. Total U.S. debt now exceeds $34 trillion. Annual interest payments on that debt exceed $1 trillion. The only way to manage this debt is inflation. Inflate the currency, pay back debts with cheaper dollars. This is the path of least political resistance, and it is extremely bullish for hard assets that cannot be printed. 3 key takeaways, and we are out. 1. The recent crash in silver and gold was not organic. Commercial traders, including major banks, accumulated over 10 million ounces of silver at the bottom, while retail investors were panic selling. The commitment of traders' data proves this. The bank participation report confirms it. This was a shakeout, not a fundamental repricing. 2. The physical market tells a completely different story than the paper market. Shanghai premiums remain elevated. Dealer premiums remain elevated. COMEX inventory remains tight. When paper price drops but physical demand stays strong, the paper price is wrong. The physical price is truth, and eventually, truth wins. 3. The macro setup has not changed. Central banks still buying gold. Industrial demand still increasing. Mining supply still constrained. Debt still exploding. Rate cuts still coming eventually. Nothing about the tariff headline or the dollar move or the short-term correction changes the fundamental case for precious metals over the next 3 to 5 years. The unresolved tension is this. Banks accumulated 10 million ounces at the bottom. Central banks are accumulating aggressively. Industrial demand is at record highs. Physical supply is constrained. And yet the paper price just dropped 15%. How long can paper fiction override physical reality? That is the question that will define the next phase of this market. That is the question I will be exploring in the next video. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Nothing in this video is financial advice. This is analysis for educational purposes only. You alone are responsible for your investment choices. Invest with logic, not hype. VIP out.